Namaskar, everyone, and welcome to this innovative program known as Fundamentals on Friday, wherein though topics which are related with academics, but not as such like GST, income tax that are being regularly conducted, we are having some different topics with expert speakers to speak on those topics. And this program we are taking every month on any particular Friday. We have those who have joined for the first time. This is I am telling this we have started from the last month, and this is the second episode I would say in the series on fundamentals on Friday. And this time we have two eminent speakers on two important topics. But before we go into the details, may I request respected Vice Chairperson of WIRC, CA Drushti Desai, to kindly give her opening remarks. Over to you, Drushti.
Thank you, Abhijit, for giving me this opportunity. First of all, I must congratulate you for this wonderful series that has been put up. I think as professionals, it is not just important for us to know the technical subject that we are required to attest or certify. We need to have a more wholesome personality, and that can only happen if we have in-depth knowledge of many other things beyond what subject we are professionally qualified to exercise. And so I think this is an excellent step that you have taken. In addition to this, I just want to say one thing, that I find that a lot of students, they spend so much time, attending classes. Even after people become chartered accountants, I find that the younger members then may not be much interested in knowing things around. And it's very important, that is why that we read newspapers every day. It need not be just the topic, technical topic of our practice, but we need to read everything, and we need to analyze what's happening around us, so that we can think 2 3 steps ahead. And that actually builds our personality, and it will take us a long way going forward. So that's it. I think we have luminaries here, learned faculties here, Marathe sir, to guide us through. And so I don't really want to take much time, but this was just a little thing that I thought, which is very apt to be spoken here. Thank you, Abhijit. Over to you.
Abhijit, I think you're on mute.
Oh yes. Anyway, thank you, CA Drushti, for your wonderful remarks. I also recognize the presence of CA Susrut Chitle, who is a regional council member. I would say senior regional council member. And now we'll be starting our first session, which is on urban cooperative banks, neglected segment of Indian banking industry vis-a-vis its untapped potential. And we have none other than Shri Satish Marathe sir as a faculty on this topic. And I have the privilege of introducing Marathe sir to all of you. Born on February 1st, Shri Satish Marathe holds a bachelor degree in commerce and law from the University of Bombay. He also holds diploma in journalism with a gold medal. Friends, all through his college days, he attended morning college and worked during the daytime to earn the living. Shri Satish Marathe sir started his banking career in Bank of India and rose to become the chairman and CEO of the United Western Bank Limited from 2002 to 2006, and also became CEO of Janakalyan Sahakari Bank Limited, which recorded high consistent growth during his 10 years tenure. Friend Shri Satish Marathe sir is the founder member of Sahakar Bharti, which was registered in the year 1979, and at presently its member of he is a member of National Executive Committee. He was the Swayam Sevak for 3 years and also president for 6 years of Sahakar Bharti, which has spread its activities all over India, and presently over 20,000 cooperatives are associated with the Sahkar Bharati. He is a founder director of Center for Studies and Research in Cooperation. It is a foundation registered under Section 8 of the Companies Act for undertaking various things related with the cooperative sector. Presently, Marathe sir is a director, Central Board of Reserve Bank of India. He is also director of National Housing Bank. He is also independent director in Indian Institute of Insolvency Professional of ICI. Friends, he's a vice chairman as well of Lakshman Rao Inamdar National Academy for Cooperative Research and Development. He is a member of Executive Committee of National Council for Cooperative Training. He is independent director for Finacus Solution Private Limited, and so on and so forth. The list is very long. I would say, in brief, we have a very eminent personality to speak on this particular topic, and I would say of his special interest, because he belongs to cooperative sector since last 4 decades. So on behalf of WRC, I welcome Satish Marathe sir in this program. Thank you for accepting our invitation. And now the house is open, the forum is open for you. Kindly address the members. Over to you, Satish sir.
Dear friends, namaste. I'll just start with a little background and the structure of the cooperative financial institutions. We have 2 types of institutions in the country in the financial sector, particularly in the cooperative sector. One deals with issues relating to the rural sector, and the other segment deals primarily with the urban sector. While I'm going to speak substantially on the urban cooperative banks, I would also like to share with everybody that the Indian cooperative movement is the biggest cooperative movement in the world. We have more than 8.5 lakh cooperatives with a total membership which exceeds 28 crores. And if we remove the service societies out of them, actually cooperatives involved in economic activities, both in rural and urban areas, they number about 5 lakhs. It's a huge movement. The rural cooperatives in our country 100% cover all 7 lakh odd villages and hamlets in the country and cover about 75% of the rural population. That's the reach of the cooperative, which unfortunately has not been fully tapped for development in the development process of the country. On the urban side, we have basically in the financial cooperatives 2 types of cooperatives. One, we have the urban cooperative banks, and the second category, for example, is of the credit cooperative societies. Credit cooperatives are of 4 types. One, which are predominantly in urban and metropolitan areas. Then there are credit cooperatives engaged in rural areas, which are called the non-agricultural credit cooperative societies. We have Mahila cooperative societies exclusively, and we also have exclusive credit cooperative societies of employees and workers in their respective offices, workshops, and such other places. This is one side of the cooperative aspect in urban areas. The other segment channel is mainly of urban cooperative banks. We have presently about 1,550 urban cooperative banks in the country, and of the 1,550 cooperatives, roughly 1,000 banks are concentrated in the states of Gujarat, Maharashtra, and Karnataka. Another about 250 are in the states of Tamil Nadu, Telangana, and Andhra Pradesh. So 1,250 banks are concentrated in these 5 states, and the balance, roughly 300 banks, are, if I have to say, concentrated across the length and breadth of the country. It is because of one of these reasons I said that this sector has really been neglected. Urban cooperative banks till 1966 were not being regulated by Reserve Bank of India at all. For the first time in 1966, the state governments and the Reserve Bank of India entered into an MOU, and thereafter these banks came under the regulation and supervision of the Reserve Bank of India. This happened mainly because urban cooperative banks, which are a 100-year-old institution, the first one was started in Baroda years back. Its name was Anyonya Sahakari Bank. There was a clamor from the urban banks and also from the depositors of the urban cooperative banks that, like private sector banks, the banks had not been nationalized at that time. Like other banks, deposit insurance facility should be extended to urban cooperative banks. Now, as you all know, DICGC is a 100% owned subsidiary of the Reserve Bank of India, and it covers or provides insurance cover for the deposits of only regulated entities. And it was for this reason in 1966 the urban cooperative banks were brought under the regulation and supervision of the Reserve Bank of India. Typically, the cooperative bank is registered under the respective state or central cooperative act, and now before it is registered, an in principle is approval is received from the Reserve Bank about its viability, its directors, and the business plan that they do. In 1966, when it all started, almost, in fact, none of the urban cooperative banks had licenses. Then over a period of next 10 years, one by one, after the inspection was conducted fully, the urban cooperative banks got licensed. Over a period of time, they grew numerically and also in size. Way back in 2001, the share of the cooperative financial institutions was about 7% to 8% of the banking industry, which was almost equivalent to those of the foreign banks at that point of time. But then 3 disasters have struck the urban cooperative bank in the last 20 years. The first was Arshad Mehta scam. We all know that Arshad Mehta used a very small bank operating in an area less than 400 square feet and used that bank to issue BR receipts. We all know that. That was the first, I would say, disaster that struck the urban cooperative bank. Thereafter, another almost after 10 years, the urban cooperative bank was affected by what is all popularly known as the Madhavura bank scam. Now, the Madhavura scam occurred again because it was said by the bank that they had shares in pledge. In reality, there was no pledge, and they said the shares are hypothecated. But then that was a mistake, and it was something seriously wrong. So that was the second incident that really it was a disaster, and it took a very long time for the banks, urban cooperative banks as a whole, to come out of the trouble. And the most recent way when the urban cooperative banks were affected is by the fraud in Punjab Maharashtra Cooperative Bank. Incidentally, all these three incidents happened in Mumbai. And it also happened in a way that the private entities who were in no way connected with the cooperative sector or who have been cooperators utilized these banks to perpetuate the fraud. Whether it was Harshad Mehta, whether it was in Madhavura, or whether it was in the PMC. And as a consequence, there has been a feeling all along that this sector is not strong, it is weak, it is not healthy, it is unsafe to keep deposits. That's the general perception that has developed over a period of years. But if we go into the nitty-gritty of the certain figures, many would be surprised. And in fact, I had an occasion to, after the Punjab Maharashtra fraud occurred, many in the board of the Central Bank of Reserve Bank of India were also not aware of the full profile of the urban cooperative banks. The figures for March 21, I'll share some of the figures which are tentative, subject to audit. But figures for March 20 are now fully available. And the figures for March 21 are almost similar to what was in March 20. There will not be much of surprises when the audit is finalized. But just to share with you some of the figures, 84% of the 1550 banks have capital adequacy in excess of 12%. Now, this is not known to many. That is one important aspect I would like to say. If we go into the details of the Trends and Progress report of banking, which was for the year ended 31st March 20, we find UCBs which have been rated A, B plus and B account for almost 74.5%. So the deposits and the working of almost 75% of the banks are good. Another thing I would also share that these 75% banks which are rated A, B plus and B have 75% of deposits and 76% of the advances. Now, if we see all these, we realize that this is a safe sector, but with a very negative image in the minds of the general public. Priority sector lending has been a thing that has been being discussed increasingly. And if the private sector banks have been lending just 40% and public sector banks have been lending just 41% to the priority sector, urban cooperative banks have traditionally been lending around 50 or at times more than 50% to the priority sector lending. So the underprivileged sections of our society, the areas where we need to deploy credit has all been taken care by these banks. Now we also have C and D rated banks. Not just because they are rated C, I won't say that they are all bad and they will not improve their working. Over a period of time, generally what we have found is that banks in C category over a period of 2 to 3 years improve their working and then get rated B also. But The cause for concern would be for D-rated banks. And here I would like to share that D-rated cooperative banks, which number about 80 of the 1550, account for a total business of just 4%. And with the recent increase in the deposit insurance cover, which was increased from 1 lakh to 5 lakhs, none of the depositors of even D-rated cooperative banks would be losing any deposits. So I wanted to bring these figures and these facts before all of the participants over here. One more area I would like to share, and that is the provisioning coverage ratio. The NPA levels, particularly in last 2 years, particularly after the onset of COVID, we did have impact of COVID at the end of March 20 and 21. Of course, we all know the gross NPAs have been hovering around 10%, and the net NPAs are around hovering around 5%. And the provisioning coverage ratio is low, particularly because of two factors. Historically, it used to be plus 75%, but this year, March 20 and even March 21, it's hovering around 60%, and that is mainly because of failures of two very large urban cooperative banks. One is, as we all know, Punjab Maharashtra Cooperative Bank, which was defrauded to the extent of 6,500 crores, and almost full amount, except a small amount, entire thing had to be provided. And the other is a bank in Bangalore called Sri Guru Raghavendra Bank that also failed in March 20. And that's the reason why the provisioning coverage ratio has been, I would say, low. But if you remove these two banks and see rest of the banking sector, the provisioning coverage ratio is healthy and there is no cause for the urban cooperative banks or the sector to be worried about. Another area which I would like to also share in this context is ever since the first fraud offer occurred in almost 22 years back at the time of Arshad Mehta, and then the Madhavura subsequently 10 years later, there has been a continuous, I would say, debate, and two words have been very common. One, they are undercapitalized. These urban cooperative banks are undercapitalized and they do not have access to the capital markets. And as a consequence, the risk-bearing capacity is low. That was one major point that has always been talked about, in fact, against the sector. The other point has always been from the Reserve Bank of India that urban cooperative banks are regulated, they have a dual control, and our capacity, the Reserve Bank's capacity to intervene in at the right time to resolve a crisis, they do not have the powers. About the first point, I would say that despite the urban cooperative banks not having access to capital markets, as I mentioned earlier, more than 75% banks have capital adequacy in excess of 12%, 3% excess than what is stipulated by the Reserve Bank of India. There are many banks which have capital adequacy ranging between 15, hovering around 15% also. So raising of capital should not be a difficulty for the urban cooperative banks when required. But then that has always been a point that capital, they don't have access to capital markets, and as a consequence, their capacity to raise capital remain well capitalized and raise capital when necessary is limited. The second aspect which has always been said is about resolution. Now, if you remember, when Dr. Urjit Patel was the governor, before one of the parliamentary committees, he made a statement, you all may remember, that Reserve Bank looks to ownership neutral, full regulatory powers. That is what he had mentioned. Many who are not equipped to technically understand this statement or analyze its real impact have missed the point that he made. What he said was that all types of banks, we should have full regulatory powers. And this was made in the context of, particularly at that time before the parliamentary committee, in the context of public sector banks. He was being questioned and the committee was discussing Nirav Modi case about the Punjab National Bank and some other frauds. We all know that Dr. Raghuram Rajan, when he was the governor, had ordered asset quality review. And then over a period of time, it has been noticed that there have been more bigger frauds also. So the question was being asked, why couldn't you see it earlier and why couldn't you prevent it? That was the answer that Dr. our Urjit Patel had given at that time. This was equally applicable to urban cooperative banks. Of course, urban cooperative banks today, because there has no single license for opening a new branch has been given in last 20 years. The share which was cooperative bank share, which was about 7% way back in 2000, is today about 2.5 to 3%. And the Reserve Bank has always been saying that we need full regulatory powers. In fact, as Sahakar Bharati, for the last 4 or 5 years, much before the occurrence of Punjab Maharashtra Bank episode, in our pre-budget meetings with the finance minister, I have always been pressing that the Banking Regulation Act should be amended and full regulatory powers should be given to the Reserve Bank to supervise and regulate the urban cooperative banks. However, it was, everybody agreed in principle, but then really nothing happened. But PMC episode in a way triggered the amendments to the Banking Regulation Act, which were enacted last year. It's a good move. It was overdue. And this is important because when the Banking Regulation Act was extended to the urban cooperative banks in 1966, not all sections were made applicable. That's why many of the chartered accountants are aware that it would be read as Banking Regulation Act into bracket as applicable to cooperative societies. This was so because mainly the size of the banks was small, the complexities were still small, simple. They were not as complex as the other banks had at that time. And as a consequence, not all sections were applied. But with the recent amendment, all banks are now put completely under the supervision of the Reserve Bank of India. And as a consequence, the entire banking sector, particularly relating to urban cooperative banks, the district central cooperative banks, and the state cooperative banks, are now under complete purview of the Reserve Bank of India. This is a very welcome sign. There has been a debate, particularly in Maharashtra, that cooperative is a state subject and how can center enact an amend the Banking Regulation Act and amend and extend the provisions of Banking Regulation Act to the banks registered under respective state cooperative act. Friends, let us understand that there are two aspects to this. The first is cooperative, yes, is a state subject, but if we see the list, union list, banking is a central subject. And when a subject comes under the central list or the union list, the central government has the powers to enact law, number one. And the second point, which also I would like to clarify, because a lot of misunderstanding has been created in media, particularly Marathi media, by some political parties, that cooperative in a way is a general law. It applies to sugar cooperatives, it also applies to housing societies, it also applies to dairy cooperatives and a host of other cooperatives, because there are some 55 types of cooperatives that operate under the Cooperative Act. So there is another principle also well accepted by both high courts and Supreme Courts, that a specialty law will prevail over the general law. So there is nothing unconstitutional or anything that has been done by amending the Banking Regulation Act and extending it to the Urban Cooperative Bank. Now I would like to go to the profile of the urban cooperative banks. Many of you must have read a write-up in yesterday's Economic Times on the DICGC, that 98% of the total number of accounts in the country get covered by this 5 lakhs insurance cover, number one. And the second point which was made in that is that cover has been extended, and if a bank is put under any sort of moratorium, directions, restrictions on refunding the deposits, within 90 days or a further extension of maximum another 90 days, that is total 6 months. At the end of 6 months, definitely the depositor would get his money. Now, as I mentioned, looking to the profile of the urban cooperative banks, the number of banks in A, B plus and B category, and an insignificant number in D category, I feel that this sector should really have been promoted. It has been, as I mentioned earlier, extending very wholesome support to the segments that are really need of money. Perhaps some of you must be knowing that almost of the total credit in the country, including medium-sized units, I am saying, when I talk of MSMEs, not the small and micro enterprises, but also the medium-sized units, a data says that just 17% of the total credit or thereabouts, could be a little more, little less, has been extended to this sector, which has been generating huge income earning opportunities and employment through organized and unorganized sector. Unorganized, I am saying, because recently there was some reports about the MSME segment, and we found that of the 6 crores and odd units in the MSME segments, just 25 lakhs really make or could be called something of a size. Rest of all are really tiny enterprises providing income earning opportunities and giving employment, small or big, to almost 10 crores of our population. Now, as I mentioned, that urban cooperative banks, despite lending more than 50% to priority sector, didn't get the support both at the policy level and at the institutional level for it to expand its wings in different parts of the country. That's number one point I would like to mention. Here also I would like to say the Gandhi Committee report on the urban cooperative banks, though it's a little old, maybe about 4 years back, things have not substantially changed. And borrow limits, that is advances per party, with limits less than 5 lakhs, account for more than 90% of the total borrower accounts in this sector. So if we see, it is these banks which are really supporting the lower income strata of our society, both for gainful engagement and also to a great extent on personal loans and consumption loans, which are also so very necessary in our country. That is what is really necessary. The third point I would say, these cooperatives do not get any support from any state or central government. There is no capital contribution. There is no, I would say, forbearance on the part of the Reserve Bank or the Government of India by way of income tax or anything. Over a period of years, they have raised capital from these small segment, I would say, weaker sections of the society, 50,000 crores of capital. If you read, of course, that is for the rural sector, NABARD in its annual report of 2002 have said that it is the cooperatives which have greatly contributed in building rural infrastructure and also hugely contributed in creating social capital in the rural sector. There is no report or there is no such study which gives us some details about the urban areas. But these urban cooperative banks, which have mobilized about 5 lakh crore deposits and whose advances account for almost 60%, 3 lakh crores, are also contributing in a big way to support livelihood, support small enterprises, self-employment in a very big way. Now, somebody at some time of the other need to understand the contribution this sector makes. We should also note that the urban cooperative banks, to a great extent, both in urban and semi-urban areas, have kept the money lenders away. That itself is a big contribution of the, I believe, the sector, and that needs also to be acknowledged. From the financial inclusion part of it, yes, just as the public sector banks mobilized about 40 crores of Jan-Dhan accounts, not much Jan-Dhan accounts have been opened in the urban cooperative banks. But then traditionally, there are no limits. In some banks, they have now stipulated that minimum deposits of say 1,000 rupees or something. But in almost majority of the banks, the urban cooperative banks are not insisting on minimum balance in savings account, nor are they charging for the services as is now being increasingly charged both by public sector and the private sector banks. They have been playing a very important role in the national economy. And it is high time that the government of India and the state and the regulator Reserve Bank of India comes out with a policy for the spread of urban cooperative banks across the country. Just concentrating in 5 states does not help the country. We have been as Sahakar Bharati demanding that a vision document for the cooperative sector should be prepared and a roadmap with milestones be made known to all the urban cooperative banks for them to attain the desired levels which will be prescribed by the Reserve Bank of India. Fortunately, the Reserve Bank of India has accepted our suggestion. We had made that suggestion for over last 2 years, but recently in the month of November 2020, we had again taken up the matter, and I'm happy that the Reserve Bank of India appointed an expert committee under the chairmanship of ex retired Deputy Governor Shri Vishwanathan, who by himself is an expert on the cooperative banking segment. And the committee has also been tasked with drafting a vision document. Our suggestion for roadmap with milestones, the report is yet to be made public. I expect it to be made public very soon. And just as the other banks are available now on tap, whether it's a small finance bank, a payment bank, or a private sector bank, anybody can apply it on tap today. Likewise, a situation will soon come that will provide an opportunity for the cooperators to come together and register a bank. I do not know how many of you may be knowing or are aware. Say about 5 years back, when we used to talk about the new urban centers that are coming up in the country, I'm not sure whether that number was correct even then. But they said about 5,000 new urban centers are coming up in the country. Last week, we had our board meeting of the National Housing Bank, and during the deliberations, it transpired that about 17,000 and odd new urban development centers are coming up. With our resources stressed and the cost of operations rising both in private sector and public sector banks, I do not know how we are going to provide banking services, ensure financial inclusion, and ensure availability of credit to those who really need. I believe that this is the time when the urban cooperative banking sector, which has been neglected so far because no new licenses were given. After the Madhavura episode, you may all be surprised that even no new branch licenses were being given. And Not only that, but installation of ATM was being regulated, cash dispensers was being regulated, and almost they were put under a total ban. Now that full regulatory powers have been given, and the other demand which, or the suggestion that I have been making to the Government of India has also been now accepted, and a provision for that has been made in the Banking Regulation Act, that cooperatives, banks can also now approach the capital markets and raise long-term funds, both capital by way of shares and also by way of bonds through public issue and on private placement basis. So with these two basic changes that have now come, I believe the time is now right for opening of this sector, and particularly we need, considering, as I mentioned, that 17,000 new urban centers are coming up, and then there are no urban cooperative banks in the almost in the entire Northeast, Orissa, Uttar Pradesh, and I would also say Ladakh, Jammu Kashmir. Yes, there could be one bank or the other, small bank here and there, but then we need a strong network of urban cooperative banks. And I'm 100% sure, because I have been associated with the cooperative sector for more than 40 years and equally associated with the cooperative banking for last more than 30 years, that this sector, if an enabling environment is created, I'm sure this sector can play a big role to achieve our twin objects. One, taking the Indian economy to $5 trillion level, and two, making Bharat Atmanirbhar. Thank you. Namaste.
Thank you, Satish sir.
Shulkar
I
Sahib,
must say, thank you, Satish sir. I think after listening to you, many doubts with respect to cooperative banks are clear, and the perception about thinking the way the cooperative banks are running is being changed. There are certain questions I would like to ask to you. First one, it has been said that there is a lack of democratic control when it comes to cooperative bank. What is your opinion on this, sir?
it's not true. See, cooperative banks regularly hold their elections every 5 years. And in most of the banks, the people participating in the elections is not less than 40%. Now, we have to understand one particular aspect, why it is 40 and why it is not 70. See, cooperative banks enroll shareholders when they extend loans. And that is why continuously, year after year, the number of shareholders increase. When the loan is repaid, it is not always the shareholder resigns and takes back his share capital. So the number keeps on growing. But if he is not borrowing, and he may not be interested to come and vote, he is not actively connected with the bank. So what we have in urban cooperative banks is a large percentage of passive shareholders. Since they have repaid their loans, they are not actively engaged with the financial institution. That's why if you calculate the actual number of active members of the bank, then you will find that this 40% people who come and vote is not a small number. That is number one. Number two, see, like in any industry, or for that matter, any I would say a business. The industry or the business gets identified with the name of a person. When you talk of Bajaj, it is Rahul Bajaj. When you talk of Tatas, it is Ratan Tata. Even though Mr. Chandrasekhar is now the chairman of Tata Sons. So what has happened is that there have been very powerful, charismatic leaders in the cooperative sectors, and they being in public life, their sons and daughters also have been in public life. They have followed their parents. And as a consequence, in many cases, they have been also inducted in the boards, and over a period of time, they have taken. So to say that cooperative banks are not democratic or that they are controlled by a group would be wrong. What is the percentage of shares that a particular family in large industrial houses have to control the industry? If you see, you will agree that they have a small percentage, yet they, whether it is Munjals, Adani, Tata, take anybody. Same is the case in the sector. And not even in banking, the person who leads from the front has to be an entrepreneur. Simply because he is qualified, he is an excellent advocate, he is running an industry or something, not necessarily he will be successful. He has to be an entrepreneur. And entrepreneurship is something inborn or is cultivated, nurtured. So if somebody says no, after father, son is happening, it's not happening only in cooperative sector, across the country and across the globe. It's not restricted only to India.
Sir, well taken. Another question. The participants wish to know your opinion on the impact of new ministry on the cooperative sector. What is the future?
I'll say. See, we have been demanding as Sahkar Bharati that a new ministry should be set up for last 5 years. In fact, about 3 years back, we did have a brainstorming full session in Niti Aayog with cooperators coming from different sectors and having a detailed interaction with Dr. Rajiv Kumar, who is the vice chairman of Niti Aayog. And we have been saying that's necessary. See, across the cooperative being a state subject, in every state there is a cooperation minister independent of agriculture. At the national level, cooperatives have always been linked to agriculture. And we are the largest cooperative movement in the world. The stakeholders with the cooperative are in excess of 28 crores. The contribution of cooperatives as an entire sector, I'm not talking only of banks, but an entire spectrum, both rural and urban, including I'm talking of dairy, fisheries, and everything. The contribution is something in the region of 18 to 20% when you talk of cooperative as a sector. For such a sector, which the contribution of which is so large, we need a ministry, number one. Number two, every sector has its own development policy in our country. Atalji, when he was the prime minister, he was the first prime minister to formulate a national cooperative development policy. For last 20 years, nobody did anything. We have been asking for a national cooperative development policy. Because when there is a policy, then the entire machinery and the entire enabling environments get created. So we need a policy, and that's what we expect of the new ministry. When we met, I met Amit Bhai Shah recently, and we have given them a 14-point suggestions that this is what you should do. Then there is another thing which I would like to say. Training and capacity building is the need of the hour. We need to improve governance. We need to professionalize the working of cooperatives in our country. And unless you have a trained manpower to work in the cooperative sector, things cannot further improve. We can do a lot in the cooperative sector. And there's annually, you will be surprised, at the most, with all the 20 institutions and the APEC institution in Pune, we are not training more than 2 lakh cooperators. And if you see the curricula, it is age old. We need to completely change it. That is the second point. Then the state cooperative acts primarily are something which we have taken as a legacy from the British. When the focus of the British government was regulation and control. Post-independence, post-liberalization, the focus of the cooperative legislation should also have changed. It should have been development and growth. And to development and growth, there should be regulation and supervision. Not the first, regulation and supervision, and then whatever you can achieve, growth and development. So we have been saying that yes, put in place a robust system, give a job to the law commission, engage with the state governments, incentivize the cooperatives by announcing schemes, giving income tax concessions or whatever. In the last 8 or 10 years, you must have noticed there is a competition among states to attract investments. And overall in the country, as a consequence, our standing has improved internationally. Likewise, if proper incentives are given, if competition starts within the states, I am sure the legislations would improve, cooperative enterprises would come up, and that is the need of the hour. The next growth engine in our country to take us to $5 trillion economy or beyond is going to be agro-processing. Today, the agro-processing accounts for just 20% of our agricultural produce. In a country where the annual wastages every year is 35%. If you look to developed countries, it is almost 80%. And look to some of our Asian countries, it is 60%. We have not done enough in agro-processing. A small, tiny country like Netherlands is processing agricultural produce much more than what is even processed in the US. We can do wonders. Processed food will increase shelf life. It can be released when it is necessary. Eventually, price realization would be better and the farmer would improve. So we have a structure of cooperatives across the country today. We need to tap this. Resources are not a constraint. I don't believe resources would be a constraint. That's why for all these reasons, and another point which we have also submitted to the Honorable new Cooperation Minister is that give access to the cooperatives to capital markets. Change the laws, amend the laws, allow them to float 100% owned SPVs or 100% owned limited companies. Over a period of time, these cooperatives can partly disinvest also, raise more money and let the money flow to the cooperative sector. Those sectors which are doing well, those institutions which are doing well, money will flow. Those who are not doing well will not get the money, as is happening today even in for the corporates. So we have a grand vision for the new ministry. And the last point why we have been pressing for, as far as starting of new cooperatives in different fields, even though we are the largest cooperative movement in the world, we have missed the bus. We don't have cooperatives in mutual fund. We don't have cooperatives in health services, hospitals. We don't have cooperatives in insurance. We don't have cooperatives in telephony. We don't have cooperatives in electricity distribution. If electricity distribution is given to localized units, thefts could be much less, I believe. Water in our country for the last 10 years, when the national water policy was announced, is today a tradable commodity. It's going to be offered 24/7, they say. Nagpur is likely to be the first city, is also what is being said. What is the amount that you are going to pay to the corporation when it is going to be made available 24/7? Will the corporation provide at affordable rates? You will be surprised, in Silicon Valley, the water resources management and distribution is by a cooperative. In small countries like Cambodia also, there are water cooperatives. Now, these are some of the areas, I believe, I've listed a few only, for which the roadmap has to be drawn by the new ministry. So it is capacity building, it is allowing access to markets, it is modernizing the laws, preparing models for starting cooperatives in different sectors, and particularly in rural India for agro-processing. Thank you. Sathe Sahib, namaskar.
So, thank you, Satish sir. Now, may I request CA Sushrut Chitle to kindly propose a formal vote of thanks. Over to you, Sushrut.
Sure. Thank you so much, and thank you, Marathe Sahib, for such a amazing lecture. I think I just looked at the topic, and it's called Fundamentals on Friday. And I'm pretty sure, I mean, Abhijit has perfectly coined the term perfectly for the session or for the lecture that you gave, because it was absolutely fundamental, and it was absolutely something that anyone who may be connected with the sector or may not be connected can get a complete overview of your entire experience, at the same time of being a banker, a central banker, and a very staunch advocate of the entire cooperative movement in India. So I think thank you so much, sir, for frankly giving a very frank and a absolute no holds barred kind of view of the entire sector, as well as your view, and also the kind of efforts that you have done, and obviously what you continue to do for the growth and sustenance of the entire cooperative movement in the country. So thank you very much, sir. Thank you for being with us here today, and we hope to see you again very soon.
I will put off the web camera, but continue to be associated to listen to Nilesh ji. Thank you.
Yes. Thank you, Satish sir. So with this, the first session is completed with wonderful deliberation by Satish Marathe sir. Now it's time to have our second learned speaker, Shri Nilesh Sathe, who will be talking about economics of insurance and impact of disinvestment on business and industry. And to introduce him formally, may I again request CA Sushrut Chitre, Regional Council Member, to kindly do the honors. Over to you, Sushrut.
Sure, Vijit, and it's an absolute pleasure. Obviously, Sathe Saib again doesn't really need an introduction in an audience like this of all chartered accountants, but I think it is always good to introduce because there are many facets of one's personality which I think get unveiled when a formal introduction is done. So, Mr. Nilesh Sathe brings with him a rich experience of over 4 decades in the banking, insurance, and mutual fund industry. As we all know, he was member IR Insurance Regulatory Development Authority from 2015 to 2019. During this period, he headed the life insurance department along with legal, IT, HR, and admin for all 4 years. And he has also headed the non-life, that is general insurance, intermediaries, surveyors, health, finance, and accounts, and inspection and enforcement for a period of 1 year. So he's practically covered all the probable areas as far as IRDA is concerned. During that period, he was a member of the Implementation Committee of International Association of Insurance Surveyor Supervisors, and he has represented India in Basel, Switzerland, Morocco, Budapest, Moscow, Singapore, and other countries. He has also been a member of the Asian Insurance Forum and represented India at Manila, Bangkok, Taipei, etc. Before joining the IRDA, he was CEO and director of LIC Nomura Mutual Fund Asset Management Company for a period of 3 years. Before that, he headed the northern zone of LIC of India as zonal manager New Delhi, as in charge of marketing and administration. He has held various positions in LIC, such as executive director of a marketing channel, chief of the pension and group schemes department, and senior divisional manager of 2 prestigious divisions of Mumbai. He worked with Bank of India and Canara Bank for over 5 years before joining LIC of India as a direct recruit officer. He is a rank holder with distinction in MCOM from Nagpur University. He is also a certified associate of Indian Institute of Bankers. During 2020-21, he was advisor finance to the National Highways Authority of India, NHAI. Currently, he is on the board and audit committee member of Mahindra Manulife Mutual Fund. He is a consultant to Bajaj Finserv for a period of 4 years from 1st June 2021 and advises the BFS and its subsidiaries associates on strategy, business and regulatory matters. He is also senior advisor to Cyril Amarchand Mangaldas, a law firm in Mumbai. He takes interest in economics, literature, sports and culture. And he is in fact recently published his memoir, Never Give Up, which I'm sure everyone should read. So thank you, Saib, for being with us, and over to you for your session.
Thank you, Sushrut. So we have an authority on the topic, and may I now request Nilesh sir to kindly deliberate on the subject. Over to you, Nilesh sir.
Yes. Thank you, Abhijit and Sushrut. Thank you, Sushrut, for elaborate introduction. More than elaborate, I will say. Having associated with insurance for the last over 3 decades, first of all, let me say that we have a lot of misunderstanding about insurance. And the first misunderstanding is insurance is only for those who want to die, but it is not so. Insurance actually has twin objectives. One is for those who may die early and for those who may live longer, because annuity is also one important facet of insurance business. So with this introduction, let me tell the members that my talk I'm going to divide in 4 buckets. One is economics of insurance, how the premium is calculated, because that is an important aspect of insurance. Advantages and what are the advantages mainly to the economy. Then disinvestment, the latest decisions of the government to disinvest from LIC and from 3 general insurance companies, and what is going to be its impact. And the last and the most important for all of you is what is the role of auditors while auditing insurance companies. So I'll be dividing it in these 4 buckets. The first is the economics of insurance. Insurance is designed to protect against serious financial reversals that result from random events, intruding on the plans of individual. See, every word is important here. It's a protection against the serious financial reversals One may think that I'm earning enough and I will continue to earn enough till my retirement or till my death. But that doesn't happen. That may not happen. And there are random events, maybe loss of job, maybe death of very near in the family or his own death, or loss of employment, so on and so forth. And the plans of the individuals may go awry. So insurance is, the economics of insurance is basically for protection. It's not just a protection of human life. Insurance covers a large domain of general insurance, right from indemnity to theft, to fire, to motor, health, and all sorts of things. There are some restrictions or limitations on insurance protection. It is restricted to reducing those consequences of random events that can be measured in monetary terms. Which cannot be measured in monetary terms, insurance cannot be given. Insurance does not directly reduce the probability of loss, meaning thereby that just because you have taken insurance, the probability of happening of that event doesn't go down drastically. So this is what it means. There are many examples of situations where random events may cause financial loss. The destruction of property by fire or by storm or by floods. We have seen it in Maharashtra recently. A damage award imposed by a court as a result of negligent act. That is why there is a policy for indemnifying such risks, which the professionals do take. Prolonged illness may strike at an unexpected time and result in financial loss. We have seen it recently in COVID. There has been devastation of financial loss, huge financial loss for many individuals. The death of a young adult may occur while long-term commitments to family or business remain unfulfilled. This is a major aspect of insurance. In case of death, whatever plans the person has for his family, for protecting his family, for education or for wedding or so on and so forth, that may come to a standing halt. The individual survives to an advanced age. Resources for meeting the costs of living may be depleted. As I said, insurance covers the risk of dying early and living long. Now, this risk of living long is increasing nowadays for the reason that the longevity is going up year after year. We never thought of people surviving beyond 100 years. But in our own families, we have now many senior citizens who are 90 plus and still quite active, not bedridden. So the longevity is going up. And the annuity rates are coming down. The interest rates are coming down. So how can one survive for a longer period of time when the income has totally stopped? That provision also can be made through insurance. So an insurance system is a mechanism for reducing the adverse financial impact of random events that prevent the fulfillment of reasonable expectations. The expectations have to be reasonable. You simply cannot think that I want to have annuity double my income, which was at the time of retirement. You simply cannot have unless you have huge amount of corpus generated during your lifetime, plus maybe some hereditary assets that you get. Is insurance a gambling? Because in gambling also, you pay some money and you get huge amount of money, if at all it strikes you. It's not gambling, because a typical gambling arrangement is established by defining payoff rules about the occurrence of an contrived event and risk is voluntarily sought by the participants. In insurance, there are principles of uberi mai fidei, as we call utmost good faith. There is a principle of moral hazard, insurable interest, and indemnity. What does it mean? It means nobody should derive profit in excess of loss, meaning thereby that if I have insured my house for 1 crore, the value of my house should be more than 1 crore. Then only I can insure it for 1 crore. It should not happen that the value of a house is 40 lakhs. I insure it for 1 crore with the intent that when the event happens, I will be able to make profit out of it. That is something which is important, and that is a basic principle of insurance. Then the next is how is the premium calculated? Premium is calculated based on a very scientific basis, and it is the work of the actuaries. Many of you might not have known what the actuaries do, but for you, for those who do not know about it, let me tell you that an actuary is an inseparable part of an insurance company. Without actuaries, insurance companies cannot work. What do they do? Just as the chartered accountants look at the valuation of assets, the actuaries mainly look at valuation of liabilities. And the valuation of liability starts from properly evaluating the premium structure. It's a science of probability. General insurance or health insurance, which is only for a year, it's an annual contract, renewed every year. The event may happen or may not happen. If it doesn't happen, then whatever premium the company has received goes into the revenue account. But that is not the case with life insurance. It has a long tail. And as a result of which, one should be in a position to fix the premium, which the insured should continue to pay for life. And the insurance company should be in a position to honor commitment that it has given to the insured. So it becomes difficult. There are 3 important assumptions which an actuary has to make while designing an insurance premium or an insurance plan. The first is mortality. Everybody knows what is general mortality. Every 10 years, the census is being made and the rates are published, mortality tables are prepared. There is something called select mortality. And the select mortality is, suppose an insurance company has insured X number of people, how many of them die year after year, which becomes a select mortality of the insurance company. Now, generally, select mortality should be favorable to the general mortality. Because in case of general mortality, irrespective of medical facilities available or not, irrespective of what is the income, irrespective of how many children are there in the family, irrespective of whether the children are born in hospital or not, everybody is taken into account while assessing the general mortality, and hence generally it is unfavorable. Select mortality, where the insured are being selected or chosen. So obviously the select mortality has to be favorable than the general mortality. But the insurance company has to take into account both the experiences, what is general mortality as well as select mortality, and the actuary has to decide upon what rates for mortality should be charged. This is his assumption. Second is interest rate assumption. Because in case of life insurance, premium is being paid every year, which obviously will have to be invested. And the interest rates, everybody knows, they move in cyclical direction. Right now, they are likely to go down, but maybe after a couple of years, they may go up. When they will go up or when they will come down is to be assessed by an actuary. That is his assumption. And the third is the expense assumption. And the expense assumption is, just take an example of sending a letter by post. It used to be 5 paisa, 10 paisa when I was a child. Now an envelope costs 5 rupees. But again, whether insurance companies are sending anything by envelope, I don't know. Now the cost has further come down because of emails and SMSs. So you get premium notice by email, cost of which is almost zero. So the expense assumptions are also very important. One has to take into account how the economy is likely to grow and what are the likely expenses that are likely to go up. The major expense in case of expense assumption is commission expense, and the second is administrative expense. Once these three are assessed, then age-wise, how many people are likely to die when they get themselves insured at age X? At age X plus 1, how many are going to die? X plus 2, how many are going to die? So on and so forth. Based on that, and taking all these aspects into account, that some policies may be surrendered, some policies obviously after death will not continue, the premium will not continue coming. So taking all these things into account, age-wise premium is being worked out. So it's very difficult, and probably that is the result why we have comfortably over a lakh chartered accountants, but there are hardly 400 actuaries in India even today, and young actuaries are still less. Actuarial science is no doubt it is a science, but one needs to have perseverance. There are 15 papers to be passed, and there are very few chartered accountants. I know a couple of them who are chartered accountants as well as fellow of insurance of actuaries. But those who are good at mathematics, economics, and social science, they can think of trying this profession. It's a very paying profession. Working out a term insurance premium is comparatively easy because again, it's like a short tail. When a person pays the premium in a year, if he dies, then the amount is to be paid. If he doesn't die, then nothing is to be paid. But in case of endowment type of policies, where some amount is to be paid on maturity as well, not only on death, but on maturity. Calculation of premium has to be done, as I said, on these parameters. But then again, having only an endowment plan is not enough. There are people who think that, yes, I want some money to be received after every 5 years or every 4 years. The intermittent payments are required to be made. Some people say that, see, I am in active service today. I do not want to keep on paying premium for 60, 70 years of my age. I want to pay only for 10 years or 15 years. I don't want to pay thereafter, but my risk should be covered and I should get some amount on maturity as well. Again, this benefit is different. There are people who may say that, fine, I know that in case of term insurance, nothing is paid if I survive the term, but then I want my premium to be paid back to me. So when something is to be paid back, again, there are some complications in working on the premium. There are without profit policies where sum assured is guaranteed. There are with profit policies where whatever amount of bonus is generated by way of surplus is distributed to the policyholders in the proportion LIC gives it as of now in the proportion 90 to 10, 10 to the shareholders and 90 to the policyholders, while private insurance companies pay 95 to the, I'm sorry, I correct myself. It is in case of life insurance corporation, it is 95% to the policyholders and 5% to the shareholders, which is government as of now. And the private insurance companies pay 90% of the surplus to the policyholders and 10% goes to the shareholders. There is likely to be a change in this structure after the IPO for LIC is issued. That we'll talk later. So this is how the premium is calculated. The next is on what are the advantages and what is its impact on the economy. When asked what insurance does, most people are likely to say that it provides protection against the financial aspects of a premature death. Yes, that is true. However, the industry's contribution to the economy goes much further. One could point to the millions of people employed in insurance and related activities. There are agents who are self-employed. There are more than 4 lakh employees of the various insurance companies. And it adds billions of income tax and premium taxes paid. You are aware that there is 18% of GST which is charged on insurance premium, and there is rupees 2 per thousand of sum assured as stamp duty which is paid to government. 18% of GST is not acceptable, but then it has been there. There have been representations by insurance companies that when government cannot provide for social security, why is it that government is charging such a huge amount of tax, indirect tax, GST, on insurance premium? But having said so, as of now, government is charging 18% GST on insurance premium, while there is no GST on mutual funds and on postal deposits. The first important contribution of insurance companies is the financial first responders. Oftentimes on site at the same time as emergency officers, insurers make every effort to restore claimants and beneficiaries quickly and reliably their financial position. This lessens the costs of unexpected losses and benefits even amongst those not directly affected by loss, like the family members. Insurers are risk mitigators. Insurers sponsor and promote knowledge and activities that save lives and protect and preserve property. They are capital protectors. Insurers are not as susceptible to short-term liquidity crunches as are other financial services firms, especially the NBFCs. Reinsurers further stabilize insurer exposure to loss by spreading and diversifying transferred risk. This is risk mitigation. Insurers are partners in social policy. Insurance is an instrument of social policy. By providing significant social benefits, such as compensation for injuries at work, rebuilding property after catastrophes, insurance contributes to the rebuilding of people's livelihood as well as to the economy as a whole. They are sustainers of the supply chain. We find that in case of exports, insurance is a must.
Women's freedoms. Women could not work, could not learn, were heavily veiled, were often stoned and killed in public executions. The leaders of Taliban 2.0 moderated their views as proof, tweeting videos of girls going to school or of Taliban.
Probably Mr. Marathi's phone call was on. Capital infusers. Insurance reduces the risk for rainy day funds. Rather than having to set aside a relatively large amount of money to pay for unexpected losses, consumers and businesses can buy insurance for a relatively small premium, thereby putting more working capital into economy, producing and consuming more goods and services to create a higher standard of living. The next is the community builders. Insurers are among the largest investors in the world with more than 10 trillion of assets under management. Even in India, the assets under management of life insurance companies has touched 40 lakh crores. while mutual fund AMC's assets under management are still about 20% less than that. They are at 35.31 lakh crore as on 31st of July 21. Since these investments need to be available to pay long-term claims, investments often include private and municipal bonds, government securities that help communities grow and thrive. Infrastructure enablers. IRDA has mandated 15% of insurance companies' investments to go into infrastructure, maybe infrastructure bonds of infrastructure companies or their shares or so on and so forth. Similarly, IRDA has mandated that 50% of the investable funds of insurance companies should necessarily be invested in government securities. So they are community builders and infrastructure enablers. There is no such precondition of any other form of saving, neither in mutual fund nor in banks, that compulsorily the regulator has directed the companies which are which take money from the public to invest into government securities or into infrastructure. It is insurance which does that, plays that role. There are credit facilitators as well. We understand that when somebody takes loan, maybe housing loan or vehicle loan, in case of his premature death, then the entire loan is to be paid back by the family. So there are products designed by insurance companies like Credit Life, where either on single premium or annual premium, whatever is the amount of loan outstanding, that can be covered by paying a small amount of money towards premium. And many families get benefited because of this, because in case of unforeseen event, when the earning member is no longer there, then payment of installments is a big question mark. And since the property is mortgaged, there is a possibility that the family will have to leave the house and literally be on streets. So credit life insurance is one such product which insurance companies offer for covering the outstanding loan, and the premium is pretty low. The last is it helps the economy by bringing in more foreign exchange. You may be aware that when insurance sector initially was opened up for foreign investors or foreign promoters, the ceiling was 26%. Later on, it was increased to 49%. And now recently it has been increased to 74%. When it was increased from 49%, when it was increased from 26% to 49%, the foreign insurance companies, rather the foreign promoters, most of them have insurance companies, the foreign promoters, they infused more than 35,000 crores by way of capital into Indian insurance companies. Now, since again there is an increase from 49% to 74%, again the inflow of foreign exchange will come into India, maybe to the extent of 20 to 30,000 crores. So the insurance companies do play an important role in getting the foreign exchange as well. The next topic which I'm going to talk about is disinvestment in insurance sector. Very recently, in the latest budget, our finance minister Nirmala Sitharaman announced that the IPO for LIC will be issued during the current financial year. And also, one general insurance company will be sold out, for which a lot of amendments to the various acts were necessary. And they have all been in place now because the parliament, both parliaments have approved it, the Rajya Sabha and the Lok Sabha. The public sector general insurance companies were governed by GIBNA, which means General Insurance Business Nationalization Act. And as per its stipulation, government's stake in public sector general insurance companies cannot come down below 50%. But now, since government has decided to bring it below 50%, obviously this provision was to be amended. And in order to enable this disinvestment, GIBNA has been amended recently, and it provides that the stake of the central government may come down below 50%, and the control of such undertakings shall be passed on to the board of directors. This has paved way for disinvestment of public sector general insurance companies, which are Oriental Insurance Company, National Insurance Company, United Insurance Company, and of course New India as well. Initially, 3-4 years before, when Mr. Arun Jaitley was finance minister, he had announced that the 3 insurance companies will be merged together. There will be consolidation. Again, he repeated it in the next budget, but nothing happened. And finally, now since government has decided to sell off its stake, that proposal has come to an end. So obviously, going forward, these 3 insurance companies, and New India is already listed, everybody knows about it. So the stake of government is likely to come down below 50% in the general insurance companies. But that is not the case with Life Insurance Corporation of India. Government has made it clear that at no point of time, it will reduce its ownership below 51% from LIC. Similarly, SEBI has given some dispensation by way of which below 10% shares can be sold of LIC, maybe between 5% to 10% to general public. And if at all 10% of the shares are sold, there is a likelihood that on listing, the market capitalization of LIC will exceed the market capitalization even of Reliance, which is highest today. But then it's not as easy as that, because a lot of steps are required to be taken before the IPO is announced. The first is finding the embedded value. Now, embedded value is something which is the present value of the future earnings. So in case of LIC, it was never done. In case of 3 life insurance listed private insurance companies, it has been done. But working that will need a lot of expertise, and government has appointed Milliman, which is an actuarial firm, to do that. Similarly, for the purpose of listing, a lot of paperwork is required to be done, for which government has appointed Deloitte and SBI CAPS to assist LIC in doing all that. Couple of amendments which were required to be made to LIC Act have already been passed, as I said. The first most important was, it was enacted by the Act of Parliament. It will continue to be a corporation and it will not be converted into a company. Secondly, the share capital, which was 100 crores, will be enhanced to 25,000 crores, the authorized share capital, divided into 2,500 crores shares of rupees 10 each. In addition to that, LIC will be allowed to issue bonds, debentures, etc. in due course of time whenever required. This amendment has been made. Section 4 of the LIC Act, which provides vesting of general supervision and direction of affairs of business of LIC, which was with the government, will be given to the board of directors. Means the board will be empowered for overall supervision and direction of the affairs of business of LIC. There are other amendments as well. New sections have been introduced for constitution and composition of an executive committee to provide for annual general meetings, appointment of auditors, declaration of dividends, so on and so forth. But most important is Section 37 of the LIC Act gave sovereign guarantee to the policyholders for the monies which they have placed by way of premium with the LIC. This particular section has not been amended or has not been touched, meaning thereby that in future going forward as well, the policy monies will continue to enjoy the sovereign guarantee of the government. The above changes are really positive and will go a long way in bringing more transparency and accountability in insurance sector in India. The board will have more than 50% independent directors who will be chosen or selected from the experts in the respective fields. As of now, there are many investments which sometimes we feel, why is it that LIC has invested in these companies? Maybe an example of IDBI or maybe New India and GIC, where even now the rate at which LIC bought these shares, it has not crossed that in the market. Such investment decisions going forward, when there will be more than 50% independent directors, may be questioned by the directors. And of course, in the annual general meeting as well, anybody having even one share of LIC can raise his hand and question such decisions of the management. So there will be better investment and more transparency and better corporate governance, which is again expected out of these decisions. So let us hope that the listing will happen in the last quarter of the financial year, this fiscal, and the rate at which it will be quoted will be reasonable, in the sense it should not be inflated unnecessarily by the government with a view to garner more and more funds by way of disinvestment. It should be appropriate, unlike the GIC and New India, where at the time of listing and even thereafter, it did not touch that level. It should not happen so. It will be devastating. Second is, it should be ensured that the issue gets oversubscribed. Because in the past, we have seen that LIC has helped many companies, many government companies, to ensure that the issue gets oversubscribed on the last day, last minute, I would say. But for LIC share, there is no LIC which will support it for oversubscription. It has to be through the process of official process of subscription, through employees, through policyholders, and through the public, and of course foreign institutional investors as well as domestic institutional investors. So that is also to be taken into account, that the issue must get oversubscribed, as well as whatever is the offer price and whatever is the price at the time of listing, at least some increase, maybe 10-20%. We have seen it like in the past, the shares got listed at 50% or 60% or 100% above the offer price. The IRCTC issue is an example of that. Some such thing should happen so that the interest of the investors should continue. One question on shareholders and the policyholders sharing of surplus. It is nowhere stipulated by the regulator that upon listing, the policyholders share in the surplus should come down to 90% from 95%, which is prescribed for LIC. So it is not a stipulation, but over a period of time, and maybe steadily it may be brought down from 95 to 90, because again, a fine act will have to be done by the management. If they continue to have 5% to the shareholders, probably the dividend may get impacted and the share may not continue to be that attractive. So that also should go up. At the same time, the bonus rates which are declared should not come down drastically. At least by 2 rupees it will come down if it is brought from 95% to 90%. That also should not happen. They should be in a position to hold on the business, the bonus rates. So maybe steadily over a period of time, the surplus distribution between the shareholders and policyholders may be maintained at 10% and 90% over a period of time. The next, for 5 minutes, I will talk about the role of auditors, because many of you might have audited the insurance companies. but at no point of time one thinks as to what way it is different from auditing the other companies. The first and foremost important is we have to ensure or verify that the premium is received first before the risk is covered. There is one section 64 VB of the Insurance Act 1938 which says that no risk shall be assumed by insurer without receipt of premium. I'll give some couple of examples. Mainly the Government of India schemes, they do not pay premium in advance. Again, the auditors sometimes feel that the government is going to pay today or tomorrow, what difference it makes. But understand that it is a violation of the Act. I remember a couple of insurance companies complaining to regulator that the premium of Fasal Bima Yojana, which is a government scheme, has not been received by them on time. But that has not been reflected in the auditor's report. Understand that if it is not done, it's a violation of Act. One has to be careful. Even in the past, when I was in LIC, there was a scheme of government, RGLIS, which is Rajiv Gandhi Life Insurance Scheme. It was for the poor families. Government did not pay premium on time. And that time auditors, I don't want to name them, but they insisted that this must be mentioned in the audit report. But ultimately it was dropped. Whether it is dropped or not, I just want to bring it to your notice that it is to be ensured that the premium should be received by the insurance company before the risk commences. For higher period items should be checked. Verification of claims is absolutely important, especially in case of general insurance. Claim might have occurred, but might not have been reported. So adequate provision should be made for that. All the claims incurred and paid should be accounted for properly. Estimated or anticipated claims pending settlement should also be provided for. They are called as claims incurred but not reserved. There is another form which says claims incurred but not enough reported or reserved. Means still the work is going on. The surveyors are assessing what is the actual amount of loss, but whatever is reported, that must be accounted for or provided for. Further, understand that premium is an item of the revenue account and so is the claim. So there should not be under-reporting of claim and over-reporting of premium. These are the two aspects auditors must take into account. Then verification of commission. Commission accrued but not paid is one item which has to be seen properly because the March business commission will be paid in April. So that has to be accounted for in the previous year. Same is the case with rents because the rent for March will be paid in April, so on and so that you do in due course of time. Then verification of operating expenses. All the administrative expenses, they are where auditors must check. If the expense is in excess of 5 lakhs, it must be checked. Or it is 1% of the net premium, that must be checked. Whichever is higher should be checked and should be shown separately. Expense not directly relating to insurance business should be charged to shareholders' account. Bear it in mind, this is very important. And third is, in case of remuneration to CEOs, MDs and full-time directors, any remuneration beyond 1.5 crore has to be charged to shareholders' account. And it needs an approval of regulator. From balance sheet point of view, there are three important audit points in insurance companies' balance sheets. One is investments. There is policyholders fund and shareholders fund. In case of LIC, there used to be only one fund. But post IPO, there has to be two funds. And that is a big work going on in LIC, how to segregate between policyholders fund and shareholders fund. That has to be seen. They should keep in mind some of the provisions of Insurance Act 1938. An insurance company can only invest in approved securities. However, it can invest otherwise than in approved securities if the following conditions are satisfied. Such investment should not exceed 25% of the total investments. If a security is downgraded, it goes into unapproved investment. So that is also to be checked. And they should be made with the consent of board of directors. An insurer should not invest in shares or debentures of insurance or investment company in excess of least of the following. One is 10% of its total assets and 2% of the investees' subscribed share capital or debentures. And the third important is no insurance company can invest in shares and debentures of private company. This is also to be seen. Then co-insurance balances. This is very important. Many insurance companies do not reconcile the co-insurance balances. And IRDA has very strictly issued a circular recently and has brought it to the notice of all auditors that it must ensure that the co-insurance balances are properly reconciled. Then the last is you cannot audit every branch, but the sample branches should be audited, and small, big, medium, so on and so forth, and ensure that the accounts are properly presented. The last is what are the latest trends in insurance. I will cover in just 2 minutes. Abroad, there is something called as trading in policies, life insurance policies, which are endowment type of policies. They are traded. Suppose you need money and you want to surrender the policy. So there will be a company which will say that instead of surrendering the policy, we'll pay you that much of money right now and continue your policy to be enforced. They will keep paying the premium. And on maturity, since this policy will be assigned in favor of that company, will be received by that company. This is called trading in policies. That is as of now not in India, but it may come. Second is risk-based capital. You are all aware that maybe in the next 2 years, latest by 2025, the risk-based capital will be introduced. And like RBC was introduced, like the Basel norms were introduced for banks, the risk-based capital is going to make a sea change in the capital structure of insurance companies. Then there is a likelihood of introduction of risk-based supervision. As of now, the supervision, which is called inspection, is carried out of all insurance companies once in 3 years. But primarily with the introduction of risk-based supervision, the companies which are doing more risky business or whose solvency margins are not enough, primarily they will be supervised with more focus than the insurance companies which are not doing that risky business. There is one more trend which is likely to happen is premium financing, and that is likely to be in case of general insurance companies, because the companies have to pay huge amount of money by way of premium. So they have to shell out that money from their kitty. Instead of that, there are companies which are operating abroad, which may happen in India as well, that the premium may be financed by the insurance company, and in the process, the insurance company may be financed by third parties to the insured, and the insured, it will help the insured to pay the insurance premium. The next is the surety insurance. Many times a guarantee is required to be given, and that may be 1% of the cost of the project or 2% of the cost of the project, and you have to have fixed deposit with the banks to that extent, so on and so forth. Instead of that, a surety insurance may be introduced by way of which surety will not be required, but in case of default, the insurance company will pay the amount of claim. There is a basic principle of investment. Insure first and invest later. Everybody must be adequately insured before he starts investing in either mutual funds or shares or fixed deposits or whatever it is. and how much he should insure, a thumb rule is 100 times of his monthly income or 10 times of his annual income. At least that much insurance is required. And for that, if you set aside 2 to 5% of your earnings, that is enough to cover your risk on life to that extent. So in the end, I will only say that insure first and invest later. With this, my talk comes to an end. If there are any questions and if time permits, I'm here to reply.
Yes, thank you, Nilesh sir. Such a wonderful session. I would say a 360-degree view of the entire insurance industry. There are, yes, certain questions I would like to ask on behalf of the participants. First one is, it is been heard from years that the insurance business has not penetrated in India, though it is existing from last, say, more than 100 years. What is your opinion on this? In my personal opinion, the case is not correct. What is, sir, your opinion?
See, world data indicates that while insurance penetration all over the world taken together is 7.4%, in India, it has for the first time crossed 3% in case of life. And in case of general, it has for the first time crossed 1%. While abroad, you will be surprised to know that the penetration of general insurance is much more than the life insurance. General insurance penetration is more, but in India it is not so as of now, because we are not aware. There are two issues, two very important issues. One is, just take example of what happened due to floods in Western Maharashtra. Despite floods were there 2 years before, not many shopkeepers have taken shopkeepers insurance policy. Why? Because there is government to pay. Why should I take insurance? Unless and until in such tragedies, government stops paying to those who are impacted, insurance penetration will not go up, because everybody, even if he has insured, he will not declare that he has insured his shop, because government is paying. No booties are given abroad. In US, if your car is getting flooded or house is getting burnt, it is not the responsibility of the government. Here, if my house collapses, it's government which will come to the rescue. Government should not do that business. Then only insurance penetration. This is one part. Second is, basic requirements are obviously roti, kapda, makan. Then the third comes, rather the fourth comes of insurance. So long as we have 40% of people living below poverty line, you simply cannot expect them to take insurance. Then there should be some group insurance, which government has now come out with PMJJBY, PMSBY policies, where government indirectly is subsidizing or helping them to take insurance cover. But insurance penetration will go up only when the standard of living will go up, only when the awareness will go up. We have seen in the past couple of years, the mutual fund awareness has gone up because of large advertisement campaign which has been taken up by MFI. Similarly, in case of insurance as well, when the financial awareness will go up, then the importance of insurance will be understood by the individuals. So two important things: penetration is low because standard of living is low, because the income levels are low. Penetration will go up once these go up, and there are indications that they are going up, as a result of which last year, when the penetration was at 2.82, this year, despite COVID, life insurance penetration has gone up to 3.20, which is a good indication. Density is again another parameter, although we have not spoken about it. Our density, which is premium per capita, is also pretty low. It is as low as the data shows, 5,850 in India, while the world average is 60,000 rupees if we convert it into rupees. So 10 times. So density is low, penetration is low, but both things will improve when the income levels go up and when the growth of population comes down. But it is low, it's a fact.
There are news in last couple of weeks that the payout ratios as compared to the premium received are more for many insurance company, particularly I believe for Mediclaim and other type of policies. So whether you foresee any increase in the premium looking at this more payout in claim as compared to the premium received?
There is a likelihood and nothing wrong in that, because the insurance works on the principle of equity. Neither insurance company should make huge profits, nor the beneficiary should be at a huge loss. If the insurance companies are at a loss, they have got every right to increase the premium. And we have seen in case of motor business, two-wheeler and four-wheeler, private cars and private vehicles, premiums have come down. But in case of commercial vehicles, the losses are huge to the extent of almost 3 times to 4 times of the premium received. As a result of it, there is every possibility that the premium should go up, and why they should not go up. But at the same time, it should be more transparent. And there is no tariff advisory committee now. Premiums are absolutely market related except the motor third party. And you have seen that as a result of which in the last couple of years, the fire premiums have come down to 1% of the tariff premium. But again, one has to look at, it should not happen that you don't do underwriting at the beginning of the policy, but you focus more on underwriting of claims. At the time of claims, you should first think that yes, it is a genuine claim, it must be paid. But many insurance companies, they look at underwriting at the time of claim, and that is not fair. You should underwrite properly, charge premium properly, and then cover up your losses if at all you have.
Well, I am reading the question as I received. It is seen that commercial and especially PSU banks fund DICGC to pay claims of cooperative banks. Why not to have a separate depository insurance scheme only for cooperative banks?
Question must be for Marathe Sahib, not for me. But then insurance word is there. Let me say that
Okay.
insurance acts on the principle, as I said, there is something called as experiential rating adjustment. We call it as ERA. I remember when first time we had given group insurance policy to Infosys employees. That was the biggest insurance scheme in India. Huge amount of sum assured was given from 10 lakhs to 40 lakhs. But then we had a caveat there that if the premium received is more than 20% of the claims. More than 20 means if premium received is 120 and claims are 100, then premium will be brought down. Similarly, if claims are more and premium is less, then the premium will be increased. This is what is experiential rating adjustment. In my opinion, DICGC should look at this because they have amassed huge amount of wealth through premium collection from nationalized banks, honestly, because there has never been a failure of nationalized bank. And if you go to the balance sheet, check the balance sheet of DICGC, you will, as a chartered accountant, you will understand that there is absolutely no reason for increasing the rate of premium from 10 paisa per 1,000 to 12 paisa, not 1,000 per 100. From 10 paisa to 12 paisa, which has been made recently, there was no reason at all, despite the fact that the insurance cover, which has been increased from 1 lakh to 5 lakh, has been done. In the same premium, 5 lakh cover could have been given. There is no reason. There is no justification for increasing the premium when the ratio of premium to claims has been dismal. Premium is huge, claim outgo is less. So there is no justification. Of course, this is my view, but this is the area of Marathe Sahib, and I'm sure he will take this.
Would you like to add something?
Yes. See, if we have written to the central government and also to the Reserve Bank of India that the premium should be risk-based, even for banks. Those banks which do well premium should be less. And for those banks which are not doing well, it should be more. In fact, if the premium is more, it's a signal to the depositors that they should be more careful in their investments. In the process, we will save a lot of heartburning and hardships that the depositors eventually face. There is another point that we have submitted as far as the DICGC is concerned, that for large institutional depositors, the cover should be 25 lakhs and it should not be restricted to 5 lakhs. Number 3, what we have suggested is banks should be free to enhance the insurance cover by paying additional premium. Part of it could be contributory from the depositors if they are getting better interest rates than the other banks. Now, these are suggestions, and I believe the things would eventually mature and come out. But with the recent passage of DICGC amendment bill, now the Reserve Bank is empowered to do all these things. So far, they were not empowered legally. I believe over a period of time, this could come into force, because we don't almost, I would say 90% of our deposits today are not likely to fail, whether it is public sector banks, systematically important banks, and strong private sector banks and foreign banks taken together. 90% plus deposits will never fail. That's the general and that's why I agree with Sathe that without increasing the premium, 5 lakhs could have been a cover could have been extended.
Thank you.
Thank you, Satish sir. With this, our time is over so far as this program is concerned. I'm thankful to again Nilesh Sathe sir for sparing his valuable time and sharing his vast knowledge with all the participants. Sir, we are also thankful for sharing this new concept like surety insurance, trading in policies, and premium financing. This is something new which all professionals must understand. Thank you for sharing them, and thank you for giving, as I said earlier, 360-degree view on entire insurance sector. Sir, a last question, a personal question, I would say, would you recommend buying LIC shares?
Provided it is properly valued by the government and it gets oversubscribed. These are the two conditions. If it is not properly valued, it will not get oversubscribed, and government will have very difficult face to show. But then I'm sure that the LIC valuation will be fair, and there is a 10% quota amended in the Act, because policyholders hitherto were not likely to get any shares, but a quota was there for employees, but never for the policyholders. Act has been amended. 10% of the shares are earmarked for policyholders, and every one of us is a policyholder. So we can get from the quota also. So we will get a preferential treatment and at 10% less price. So why not buy it?
Sir, I personally also feel that when the shareholders fund is separate out of whatever surplus generated by insurance companies, as you said, 95% is given to the policyholders. I really wonder in years to come after listing, whatever profit is being generated by that insurance company, how and why any shareholder would be interested in that surplus, because whatever will happen will be only on the valuation part of the LIC, as you rightly said. They will not be interested as such into the future earning of the insurance company because of this 90% sharing with the policyholder. So what do you say?
See, those who invest in equities, they have different views. There are investors who want high dividend paying companies in their kitty. There are investors who also look at whether the share price is going up, then only I will invest. So it's not, dividend is an important criteria. You also may be knowing that insurance companies are not allowed to buy shares of companies who have not declared dividend for 3 years. Sushmit is aware of it. He has done LIC audit. So declaring dividend is equally important. Declaring good dividend is also equally important. When dividend is not declared as per expectation, what happens? The share price comes down. So ultimately, it's related. So dividend has to be there. Good amount of dividend has to be there. Just because a good name is there, that does not mean that dividend should not be there.
Okay. So thank you again, Satish Marathe sir and Nilesh Sathe sir, for sparing your time. It's a wonderful evening, I would say. Really new things to learn from the experts, the stalwart personalities like you. Thank you for being part of the WRC program. And to all the participants, again, next month on any given Friday, we'll be having another two wonderful speakers with two thought-provoking topics. So thank you, one, and thank you all. With this, the program is ended. Thank you.
Thank you very much.